All right, hello, this is Mike again with NetPicks.com and the Options Mastery Program. So over the weekend in the recap video that I did post, we walked through a number of winning trades, and I also mentioned that we've got a number of short premium trades that are working for us. We put these on a number of weeks ago. We put them on many of these positions pretty much in the panic that we saw on that move to the downside going back a number of weeks. And what typically happens in that move to the downside is volatility really expands because fear really starts to kick up. People are very scared of the downside because let's face it, none of us like to lose money, right? So when options start to get expensive, volatility is a huge input in the pricing model of an option. So when options get pricey, if I want to play a directional move, I don't necessarily have to buy a long call or a long put. I could potentially sell an option or sell a spread to collect premium. That takes advantage of the higher prices. It actually gives us more ways of being profitable. Oftentimes when we get to oversold levels, people automatically go in and just buy a call to try to play the upside move. Well, in reality, that's not necessarily the best thing to do, because if we do get the bounce to the upside, what's going to happen to volatility? If the market starts to stabilize and move higher, just use this current market for an example. We've seen a pretty impressive bounce to the upside here the last two trading days, going back into last week, right? And volatility has really contracted. What does that cause the options pricing to do? The prices of the options have come down in many cases because the volatility has decreased. So if we want to play the move to the upside, buying a long call, while you could potentially book profit, it's not necessarily the best way to do it. You could potentially be leaving some capital or some profit on the table by taking that approach. So what we did a couple of weeks back, we took advantage of the temporary spike in volatility, and we took a look at many of these charts and many of these names that have gotten beat up on the downside, and instead of just going in and buying calls to try to bounce higher, we sold a lot of put spreads and we put on some iron condor. So I want to give an update on some of those. We've covered them in some previous videos, but I do want to cover these in detail here again today because many of them, they're starting to move. We're in the October monthly options on all of these positions. So we're now down to 11 days left before expiration. When we put these trades on initially, okay, we were over 20 days out. So when you put those trades that far out in time, they don't typically, the prices of those positions don't react very quickly. Now we're starting to get a couple weeks out before expiration. These are really going to start to react quickly. So we have to make a decision. Do we want to hold these positions longer? Do we want to make an adjustment? I'll walk you through how I make that decision. So the first one that we took a look at, some of these oversold names, and in many cases, a lot of the oversold areas that I saw, the most oversold, were some energy names and some of the global ETFs. Markets like FXI, which is the Chinese ETF, and EWZ, which is the Brazil ETF. Those are the markets that really led the charge to the downside. We were early in putting these trades on. We didn't get the bounce right away. I mean, it took a couple of weeks for that bounce to really take hold, and to some extent, it really, it hasn't gone as high as I thought it would on this bounce just yet. But by selling premium, instead of having time decay work against us, we're flipping that all around. By selling and collecting premium, we can hold on to those positions longer, because the longer we hold on to them, the time decay starts to add up, and that's what we want. So let's take a look at, let's start out with EWZ. This is the Brazil ETF. And we got pretty overdone. I mean, we got very oversold. It definitely was one of those names that got very beat up on the downside. So what we did is we went in, we sold a 23.22 put spread, and we collected 33 cents for putting this trade on. That means if we collect $33 per spread like we did, that's the most money that we can make on the position. Okay, now I'm only tying up about $66 of capital to put that trade on. So even though $33 doesn't sound like a ton of money, okay, if you're only tying up 60 bucks of capital, 66 bucks of capital, I mean, you can put that on 10 times and you're still talking about less than 700 bucks. So it's a very reasonable trade to put on, and put it on multiple times. Okay, now the great part about that trade, when we collected 33 cents to put that trade on, let me get the strikes in here. We sold the 23 put and we bought the 22 put to make it a hedged position, and we're about 2 cents into profit. The neat part about this trade, we were absolutely wrong on direction for the first couple of weeks of the trade. I mean, the move continued to the downside, and we were underwater almost immediately. But because we sold premium, the time decay was working in our favor. We knew that if the market did decide to bounce, volatility was going to contract. Okay, that would also help our position. And by selling a put spread, we're expecting a bounce higher, but we also could potentially make money if we get a sideways move and if the market decides to head slightly lower. Because if I sell the 23 put, okay, that essentially is step number one to calculating my break-even point. We take our short strike, which is the 23 strike put, we collected 33 cents. Okay, so that's going to put our break-even point right around 22.67 or so. As long as we close above 22.67 over the next 11 days, I can make money. So instead of buying a call where we need a big move to the upside to make money, okay, now all of a sudden, if it does make a big move higher, great. But if we move sideways or if we even move slightly lower from here, I still make money. So now instead of just locking in on that one move, the move to the upside that we would have to see for a long call, I'm giving myself 4 or 5 different ways of being profitable. Time decay, volatility, a move higher, sideways, slightly lower. All of those scenarios, or a combination of those scenarios, would give us a nice profit. So we were dead wrong on our outlook initially. And look at where this trade is now currently printing at. I mean, 31 cents. We're back into profit after being dead wrong there for a couple weeks. That's why I like to sell premium whenever possible. Now, when we do sell premium, what we're targeting is between 50 and 75% of the maximum profit. Okay, the maximum profit is whatever we collect for putting the trade on. So if we collected 33 cents, the first place I'm going to look to take profit at is between 16 and 17 cents. Okay, so we're not there yet. I still have to hold on to this trade longer. So I can do that because time decay is going to add up in this case. So I'm going to hold it longer and hope that EWZ either stays sideways here or continues to move to the upside. That would be a perfect scenario for us. Okay, so nothing to do other than just hold the position, and we'll come in and check it once or twice a day. Okay, really don't need to watch it from open to close. We'll just let it work and let it do its thing there. So FXI, this is the Chinese ETF. We took a very similar approach here on FXI. We sold a 36.35 put spread, and we sold it originally. We collected 38 cents. So let me get the correct strikes in here. I need to get 36.35. So we sold a 36 strike put. We bought the 35 put to make it a hedged position. I personally do not like to trade naked options. It's not my style. I don't like the unlimited risk. I like to be in a defined risk scenario, even though I know by doing that, by trading a spread as opposed to a naked option, I am giving up some profit potential, but I'm completely comfortable with that because I like that defined aspect. So we collected 38 cents when we put this trade on. It's now trading for 15 cents. So we're right inside of that 50 to 75% of max profit area that we like to take profit in. If we collect 38 cents, 50% of max profit is 19 cents. So we're already past that. I can close this trade out at any time. Okay, and book the really nice profit. So FXI, again, by selling the put spread, it was a bullish play, but I gave myself multiple outs, if you will. Meaning if we move sideways, if we move slightly lower, if time decay added up, if volatility decreased, those are all potential ways for me to book profits. That's why I like selling the put spread as opposed to just going in and buying the long call or buying the long call spread. So really nice trade here. We can book the profit. I'm going to hold on a little bit longer. You know, I'm playing from a position of profit here, so it's a nice position to be in. Ideally, I'd like to buy this back for between 10 and 12 cents. So I'm going to hold on to it, see if we can get one more move to the upside here over the next couple days, and then I'll look to close the trade out. Okay, so nice move for us. The next one, we did take a look at some energy names. So let's take a look at XLE. We were trying to play a bounce higher in energy, specifically with the crude oil markets, and we've seen that just recently, which has definitely helped us out. So we sold the 63.62 put spread in XLE. Again, this was a number of weeks back when crude oil was getting beat up on the downside, and we thought it was getting a little overdone and we could potentially see a bounce. So we sold the 63 put, we bought the 62 put to make it a hedged position. We collected 40 cents. That 40 cents becomes our maximum profit that we can make on the trade. or $40 per spread. I'm tying up about $60 of capital. So again, $40 doesn't sound like a lot of profit there, or a lot of money, but we're only tying up $60 per spread. You can put it on 10 times and we're still talking about $600 of capital. So really reasonable trade to put on. So our break-even point, when we collected 40 cents, we're going to take our short strike, which is 63, and we're going to subtract 40 cents off of that. That puts our break-even point at 62.60. Now, instead of requiring a huge move to the upside to make money on a call option, okay, as long as this thing closes above 62.60 before October expiration, I can make money. So now I've got room below us. If we move lower, I can still squeeze out a profit. If we move sideways, I still make money. If we move to the moon, if oil just skyrockets here over the next couple of weeks, I make money. I make money if time decay adds up. I make money if volatility decreases. Hopefully you're starting to see this picture come together here where, why buy a call option when you only make money in one market scenario? If the market moves up, if volatility increases. Now all of a sudden we're flipping that whole thing around and we're giving ourselves multiple ways of being profitable. It's a great position to be in. So now we're trading for 21 cents. We're right at that 50% of max profit level. I could close this trade out if I wanted to. Anywhere between 50 and 75% of the premium that we collected to put the trade on, that's where I'm looking to buy this trade back. I do not hold the expiration on these trades. Okay, I will book profit ahead of time. We talk about that in our training in our options mastery program. It just, as you approach expiration, a lot of factors increase the risk of holding longer, and I like to book those profits beforehand if I can do so. So I'm going to hold a little bit longer here. Okay, ideally if I can close this out between 12 and 15 cents, that would be the perfect scenario that I'd be looking at. Okay, so again, for the traders that do have this trade on, for those that might be students of mine that are watching this video, you could close this trade out here at any point because we have hit that minimum 50% level. The other one that we looked at is USO. This is an ETF that directly is correlated with the price of the crude oil futures. So it's a really good way if you wanted a way to play a movement in crude oil futures with the use of options. USO is a decent product to do that with. So we actually put a couple of different trades on here. We sold the 14.5, 13.5 put spread. Okay, so let's take a look at that one here first. So we sold the 14.5 put, we bought the 13.5 put, and we collected 38 cents. It's now trading for 20 cents. So here again, we're right around that 50% of maximum profit. Okay, we collected 38 cents. That's the most we can make on the trade. We book profit as these options get cheaper. Okay, so we're into profit here as well, and we could close this trade out if we wanted to. I'd like to get a little bit closer to that 75% level before I close these trades out, and we were able to hold on longer. The nice part about selling premium, that time decay is adding up for you. So if I wanted to squeeze out a little bit more profit here, okay, I can do so even if USO does absolutely nothing. If we just sit here and just get stuck in the mud, I can still book more profit. That's the neat part about putting on these types of strategies. So my break-even point here is right around, let's see, I'm going to check my trade price, 38 cents. So we're just below the 14 level for my break-even point. Okay, so I've got some room below us. Even if we start to drift to the downside, I can still squeak out a profit here. So I like this position. Now we also put on a second type of trade. We put on an iron condor. So what an iron condor is we're just selling at the same time. We're selling an out of the money call spread and we're selling an out of the money put spread. So we sold the 15.5, 16.5 call spread, and at the same time we sold the 14, 13 put spread. So what this does, instead of picking a market direction, we just talked about short put spreads. Well, in those cases, ideally, those are bullish positions. So ideally, we want those names to move to the upside. What if we don't have a directional opinion? What if we think the market could potentially get into a sideways chop? Well, by selling an out of the money call spread and an out of money put spread, we're creating what we call our profit window. Okay, so we're trying to box the price in. As long as USO stays inside of a tight range, we can make money. Okay, what is our profit window defined by? We're taking our short strike, so in this case the 15.5 call and the 14 put. You have to factor in whatever we collect for putting on the trade, so it's a little bit wider than those short strikes actually. But as long as the price of USOs closes in between those short strikes, we get the book a profit. So we sold this trade for 52 cents. It's now trading for 29 cents. So we're right near that 50% of max profit level. Okay, so as long as we sit right here, if we don't do a single thing, I can make money. I can also make money if we move higher here, if we move slightly lower, as long as we close in between these two short strikes, the 15.5 and 14 strikes. So we're sitting pretty here. Okay, I'm just going to continue to hold this and see if I can get a little bit closer to that 50% of max profit level. That would be the perfect, in a perfect world, that's what I would like to see there. So we've got a nice profit going. I'm going to continue to hold the trade. Okay, let's take a look at our final position that we have on. This is in Twitter. We were in a lot of ETFs on these short premium trades. Twitter was one of those individual names that we felt got a little overdone on the downside. We were expecting it to bounce. Now, fortunately for us, with our Twitter positions, there's been some news out on a change of CEO the last couple of sessions, so that's helped our position move to the upside. But we put this on a number of weeks ago. Before we even knew there was news coming out, we put the trade on expecting Twitter to bounce higher. So we put on a couple of different trades here also. We sold the 27-26 put spread, number one. This was out in October. We sold it and we collected 43 cents. Let's go ahead and take a look at these strikes here. And it's now trading for 45 cents. So we're down by 2 pennies. Okay, we have not been right so far to this point. We still need Twitter to move to the upside, but the neat part about this, we've been dead wrong for most of this trade and we're only down 2 pennies. That's the nice part about selling premium. You're giving yourself more ways of being profitable. You're going to increase your odds of success. Okay, so ideally, what do we want this trade to do? I would like Twitter up above 27. If I can get it right at or just above 27, that'd be perfect for this trade, and we will be able to book a profit. Okay, the second type of position that we have on here, we've got the Iron Condor on, and we sold the 29.30 call spread. So let's go ahead and get these strikes in here so you can take a look at what I'm talking about and where we're at on the trade. So we sold the 29.30 call spread. We also sold the 25.24 put spread. So again, like we talked about on USO, with this Iron Condor, instead of trying to pick a big market directional move, we're just essentially trying to box the price in. We're trying to create a profit window that we'd like Twitter to stay inside of. So we sold this Iron Condor for 53 cents. It's now trading for 25 cents. So even though we haven't had the big move higher that we were ideally wanting to see on the short put spread, because we've stayed inside of our short strikes on our Iron Condor, we've been able to book profit. Okay, and we're almost at, well, we're at that 50% of max profit level. So we can start to consider closing this trade out over the next couple of days. I'd like to get a little bit closer to that 75% level. And when I say 75%, I'm saying 75% of whatever we collected for putting the trade on. So 75% of that 53-cent credit that we put the trade on for. So as long as we close in between these short strikes, our short strikes are 29 and 25. So anywhere around 27, right where we're at right now, if we just sit here and do absolutely nothing, we're going to be able to book our nice profit on the Iron Condor. Okay, so we just talked about, let's see, we talked about 2, 4, 5, 6 different trades, 7 different trades. We're winning on all of them and down by 2 cents on the other one. Now, again, I'm not going through my list and picking out all the winners to show you. These are all of the short premium trades that we put on in the Options Mastery program over the last couple weeks. So I'm showing you every position here. Now, does that mean they're all going to win? No. I mean, we have not closed any of these yet. Doesn't guarantee that they're going to win, but what I'm trying to show you here is by putting on trades that increase your odds of success, that give you more ways of being profitable than just being right on market direction, that's when it starts to get fun as a trader. It takes a lot of the pressure off my trading. You know, it's amazing for me as a trader when I sit there and compare when I'm just long a call or long a put when compared to being short premium. It's amazing the difference. It's so much less pressure to sell premium because I know I have so many different ways of being profitable, and you know they're not always going to work out. But when you follow the criteria that we outlined, over the past couple of months, I mean, our winning percentage is well over 85% because we're so strict on what we wait for. We don't always sell premium in every market condition. We wait and pick and choose when the best times are to do so. We're very specific on the criteria that we look for, and that's how we're able to get the high win rate. Okay, so just wanted to give you an update again on all of these positions. I'm targeting between 50 and 75% of max profit. I will start to look to close those trades out when I can get to those target levels, and then we'll exit those trades before expiration, and we'll start to go out farther in time. We'll go out and to look at the November options, for example, see if we can sell some more premium to get another round of trades on. So I personally, in my own trading, I like a balance. I like to have short premium trades on, and I like to have directional plays on as well. And by having that balance, I'm able to properly diversify and really start to see my equity curve, the growth in that equity curve, smoothing out over time. I don't see those wild swings back and forth. I'm not just buying long calls and long puts, waiting for those home run trades. I'm able to put on different types of positions and see that consistent growth. And that's just been just a world of difference here in my own trading and what I've seen over the past number of years. So I'll be back here later in the week, depending on what the market does. If we're able to close these positions out, I'll record a quick video. We won't go over as many details on those trades, but I'll keep you posted on what we're able to do there. So I'll wrap this video up here. Just for those of you that did watch the weekend video, we've already booked profits on a number of positions today. Booked full profits on the Google trade that we talked about over the weekend. SPY and QQQ, those trades were both closed out for full winners. XLE, all these trades that we talked about over the weekend were closed out. And it's just a great way to start the week. I mean, you start to book profits on a Monday, you can take the week off if you wanted to. Now, I won't do that. I'll continue to trade, but just the point being, when you book profits on a Monday morning, it's a great position to be in for the rest of the week. It takes a lot of the pressure off your trading. So I'll do a video here over the next couple days, and we'll walk through the details and the specific returns on those trades. So happy trading, everybody, and we'll talk to you here over the next couple of days.